All right, good evening, everyone, and welcome back to the fourth session of the story of the market. It's the last one on the series, but it's definitely not the end of the story. There's so much to read from the charts about the market than we can cover in only four sessions. Actually, if you want to do it, it's just an appetizer, this series of seminars for you. And if you're interested in that, you should dive deep, take a deep breath, and go for about a few months in really studying in this. But if you do, you promised to have a great tool for really reaping the market and understanding what's going on. So first, who am I? My name is Gil Ben-Hur. I'm the founder and the CEO of the Fivers Trading Fund. The Fiverr Trading Fund is a private-owned trading fund where we actually were building a trading career program for Forex traders, meaning that we gather around us many great Forex traders and we supply them high capital accounts to trade on our money and they trade for us. We split the outcome, we split the profits for them and for the traders and for the fund as well at 50%. And we also offer an amazing growth program, which we are very proud of, which is very unique. We actually double the capital on the accounts for every 10% growth. And with that, by 7 rounds, they can get into severe, highly capital account, which is can be over $1 million account in just 7 rounds of 10%. Um, we test our traders before they get qualified by a live trading account. So if any of you wish to try out, know that you will get a live trading account for a very low cost, which is only 4% of the value of the account. So if it's a $10,000 account, you will only have to pay $400 to receive and trade it. You will get 50% of the profits on that account, but it's still you don't risk so much on trading. It's only meant to know you as a trader, and after that, we'll start growing your account by the 2 for 10% growth plan. Okay, so our website, if you want more information, is on www.thefivers.com. And let's begin. Let's do a very fast recap. I don't have slides for the basic stuff, so if you weren't here at the past session, then just try listen and understand the concept that we're working in. Order flow is what makes price move in the market. What is order flow? These are the orders that all the participants in the market are submitting to the central exchange. If it's the stock exchange or whatever it is, all the participants are submitting their orders in order to buy or sell the contracts or the stocks, the shares that they want to hold or to get rid of. These orders are going into the central exchange, and the exchange duty is to find match between participants that wants to sell and participants that wants to buy. Whenever they find somebody that's willing to buy the same amount of contracts that someone else is willing to sell at agreed price, then we have a trade. This trade is one tick is being printed on the chart as price. And what we're looking for in reading charts are some hints where we can find places where orders were not filled by the exchange because there wasn't one side to make a trade, meaning that if we had more sellers than buyers, then price will go down. But some sellers that submitted their selling orders to the exchange didn't get their request filled. So their orders are waiting there at the specific price that they are waiting for. And when price will come back and return to that price, to return to that level, price will react to this because many traders are waiting at that point. We call these points, we call them decision points, and whoever that wasn't here on the past sessions, try to understand from what we're talking about and understand the dynamic of order flow. But just take it, take this logic with you, this concept that wherever price had a decision to move forward, up or down, doesn't matter. At that point, we can define a place where we call it a decision point, where price, where we assume that there are left some orders unfilled that are waiting for the next time. We have another thing that we have to consider, that all levels are subject to be broken at one time. And the way that we can analyze that is that if we had this decision point where price was coming back and it was taking the unfilled orders, we would assume that in the next time, in the second visit for this on the same level, we will have less or none orders that will affect price in a bounce reaction or a reversal reaction. So our assumption is that on a second return to the same level, the orders are already consumed, and we consider this level as fragile, as a one that's supposed to be broken soon. But we have more clues for that, and today we're going to talk about the odds of the successful trade. I will give you, like I promised in the past session, a cheat sheet of how to evaluate the validity of the zone, the level that we're thinking of trading. We will have a few concepts and few ideas of how to do it. Another thing that I owe you is something that is very, very important and happen very, very often in the market, which is the fake outs. And the fake outs happen all the time, and fake outs are great confirmation price pattern that allow us to confirm that a reaction to a specific zone had happened, and I will try to teach you how to read fakeouts in the language of order flow. And with that, and after we'll do that, we will go to the cheat sheets, and we'll learn how to give an estimation of the probability of the upcoming trade. Okay, so hope that's clear for the new guys. And again, please go to other to the past sessions on the recordings in investing.com or in our YouTube channel, and you'll get the hang of it. This session will be recorded as well, so if you don't understand it now, after you see the rest of the recordings, you probably will. Try to bear with us today, because probably you'll find stuff that can be very interesting. Okay, so let's talk about fakeouts. Okay, fakeouts are events that usually considered to be trying to fail traders that that would consider to trade breakouts. What happened here is that the breakout traders will consider any break of level as is, as it's, and will interpret it as a continuation of a trend. But fakeouts happen all the time. They tend to break and then give a severe drop, and making these breakout traders to fail over and over. The way that we were going to trade fakeouts will not be on the formation of the fakeout pattern, but only after we have the fakeout shown up to us. Okay, when we trade order flow, we trade only the things that we see. We don't take risks on things that we do not understand. And so once we have this situation, which is a fakeout, we can it become a tradable pattern that we can really benefit from. And also, it's a wonderful confirmation pattern that can tell us that a reaction to supply and demand levels are really working, because price probably here was reacting to supply at historical left level, which we really obligated to go and look for what is this reaction happen from. And then once we know it's a reaction and we see the fakeout pattern, we can really trade it with high probability of success. Okay, so let's just first see the anatomy of what is a fakeout. Okay, first, we like I explained in past sessions, we always need to give it to our routine to check the extremes. If we see any turning points on the chart, we really have to go and find out what caused this reversal to happen. Okay, because if we understand that order flow is what's really changing and making price to change directions, then probably this spike, this very top last trade that on top here is a result of an order flow that happened in the past. So our obligation is to go and look why this happened. And if we, and I promise you that if you keep doing this over and over and don't be lazy, just scroll to the left and see why that happened and give yourself a good explanation in the terms of supply and demand or order flow, whatever you want to call it. If you have a reason for that, you can also can calculate the power that you have to that pattern, because fakeouts will happen all the time. You see here we have also fakeouts, but it doesn't mean a lot. Here it's probably mean much more. Okay, because probably it's affected by a higher supply that happened in the left. So do yourself a favor, put it into your routine, explain yourself every single turning point on the charts, always. Okay, so first we have to understand why the tip of the fake out had happened. Second thing, we have a left shoulder that was happening, that was being printed, and that fake out was actually breaking the left shoulder. So that's just the anatomy. And once price faked out and gone below the left shoulder, and we see that price continue to go down, then we know that it's a fake out for sure. Okay, and once we have this formation, this one, we already can prepare ourselves for the fake out trade. Okay, only then we can prepare ourselves to trade the fake out trade. We need another condition to meet before we can take the fake out as a trade, and it's to see, and it's something that I keep saying over and over. We really have to measure the result of a turning point. If we had a turning point and we have a result that broken other levels, okay, then this down movement has some significance. We understand there is power to that down movement. So we understand it as this is the momentum for selling this this equity. This specific example, it's GBP JPY. Okay, but it can be anything. Commodity stock, it works on anything with a big with large liquidity. Okay, so when we have an engulfing of levels, here we have a demand level that was broken by this, that with the fake out origin movement. It broke one demand and another demand and another demand. So we assume that there are a lot of selling power on this. So we have a left shoulder, we have the fake out, and the fake out is resulting by breaking demand levels, which is the opposite of supply. Then we can prepare to sell the fake out. And what would be our entry? The entry will be the left shoulder level, the yellow line in here, and I will give you the order flow reasoning very in the next slide. I'll explain why it's the left shoulder, and the explanation will be by order flow terminology. Okay, So your trade will begin at the left shoulder. Your risk will be above the tip of the fakeout, and your target will be the next demand level, because if you're selling supply, you would want to exit at the clean demand. So you have first targets at clean demand around here, but you can, if we consider this as a confirmation for a turning point, then we can try to take the first target around here, lock break even, and let the trade run for another good demand, which can be down here around 129.89 level. All right, so this is how we look at fakeout. Pretty much the same thing. If you flip the picture, if you will have the same fakeout also for demand to supply trade. Okay, so now let's try to analyze what's going on in this situation in terms of order flow, and why is the left shoulder is the price where we want to enter. Why is that the price that we assume that holds at this case hold sales orders at the exchange that will affect our price to go down. Okay, so first we have price moving up, and when it moves down, the first time it moves down, it's obviously, like we know, it creates a supply orders. Sell orders are waiting to be filled, and they are waiting up here. Okay, so we have supply, and this level is now being considered as supply. But when price is creating higher lows and it's approaching to supply, if anyone in the market that wish to break clean orders of supply, they have to bring more power of buy orders, to bring more orders, because decision to sell was happening here, and now you have to bring much more buying forces to break the resistance that was creating here on the supply. So they push hard, and when they push hard and they break it, we assume that buying orders that were winning the sales orders some of them are left here to be untouched. And that, if you remember in the last session where we were talking about swap zones, it's exactly what happened at swap zone. Okay, so price is now free to go up. Buy orders are waiting here to be tested again when price will come back. So then we have the fake out, which is obviously creating sell orders. And again, we have to go left to understand why it happened and at this specific price. Once we know that it happened on a very a significant supply in that example, if we know it happened on a significant supply, untouched supply, then we consider this as something significant, and then price will go down with some sell force, and they come into support of buy orders. And to break this support of buy orders, they need to inject more sales orders in order to break the balance between the buy leftovers. So to do so, they inject more sell orders, and if they do break it, and they did, they created a supply zone. Again, it's a swap zone that started as a supply, turned to demand, and now is turning back to supply. Okay, and then price is going down and breaking this level and breaking another demand level, and then when it's coming back, this line, which is originally begin as the left shoulder, is a supply level. So this is why we consider the left shoulder as a supply decision point where we want to sell at this level. And if you go and learn this situation and go over the charts and see it over and over, and just a straight line from left shoulder through the fake out, and you see the reaction usually happen around the left shoulder level. Okay, you don't need to use diagonal lines. Only straight lines really work because price is king. Price is what really being considered in the market. There are no really trend lines in the, and I can prove that, but that's another session. Okay, so the left shoulder, as long as we had a fake out, which has a result of breaking significant levels, opposite levels, then the right shoulder is the level that you want to trade. So this is how we explain in the order flow language what is a fake out and how we trade a fake out. And again, the fake out pattern, this pattern, whatever it is, if it's on supply, like in this example, or the very opposite on a demand level, then it's an amazing confirmation tool for a reaction, for a true reaction that you can just wait for price to react on the level. You don't need to enter just yet, and you see the fake out pattern forming in front of your eyes, and then you have the chance to get in with high probability of taking and running on the reversal trade. Okay, so that's the fake out. Very, very powerful tool. Very powerful. Okay, so now let's go to our cheat sheet. And our cheat sheet, we will talk about how we make the possible trade. We learned before how we mark, how we plot levels on the charts by the decision points, and how we stretch the risk zone to the tip of the extreme of that zone. And so we have our trade waiting there, but now we want to have a real good assessment if that trade is going to work or not. So I took my experience and I tried to simplify it for you in a way that you, as beginners to this subject, will use it, but not as is. Always try to understand what's behind this. And so my cheat sheet will be there to help you out, but also to help you think in the way of order flow. So let's begin. Okay, so in order to make a good assessment of an upcoming trade that we want to take, we have to consider it in few dimensions. One is the analyze the past. Then we're going to analyze the approach of price to the level that we want to enter. Then, if we're not taking the level blind, we would want to see the reaction on that level that will give us better confirmation, another reason why to think that this level is working. So if we see a reaction that we're expecting to see that will confirm for us that price is really reacting to that level in the way that we want, then we can jump on the trade, and that's the reaction. One way and very powerful way to see the reaction is by the fake out pattern that we just mentioned. Okay, but there's more. Okay, so what is the past? The past is basically the origin of where price had the decision to make the move, and that is where we want to trade. And we have to go and analyze the origin itself, see what's going on, how it got formed, so we can grade it and give it a grade, or classify it as strong, weak, or medium, in order to see how much money we want to put on that specific trade. We need to have really a way to quantify the probability of the trade. So this is what we're trying to do. So in order to understand the origin, we should ask ourselves few questions about the origin. Did the move had results by breaking new levels, like I showed you on the breakout, the fake out example? Did when price was making that decision to go up, did it break supply? Or when price had that decision to go up, to go down, did it break demands? If they did, it probably has significant power in there. If it didn't, then we should question this level if it's going to work. Okay, and second question is, do we recognize that the level is clear and clean, meaning that we see the decision very easy in the eye. We see that there were no spikes getting back in there. It's very clear and obvious in the visual way. And also, if we analyze it a little deeper with a lower time frame, maybe if this level wasn't quickly being tested before price was taking its way away from that decision point. So if it's clear and if it's obvious to the eye, it's probably going to be better to trade it. The third question is, did the decision point was tested before moving on? It's partly what I said on the second point. It's many times, and I'll show you examples. Many times when price is having a decision to move away from the decision point. Price is quickly turning back, sending spike to that decision point. And as we discussed many times before, when price is testing a level, then we cannot consider that level to be we consider this level to be somewhat consumed. We don't know for sure that there are remaining orders that's going to give us the effect that we want to have. So if that happens, we have less probability for that level to work. And another thing that we want to see on the region is that when price was taking off from that decision point, did it print more levels? If let's say if price went up and it was printing more demands and untouched demands on its way up, then we know that there's a decent significant buying power that is building up. Then we move to the approach. Price is now coming back to your level, and we're going to observe the way that price is coming back. Does it come to did it already test that level? Does it come in a compression way? If it does, you remember last session, compression are very great tools. Compression formation that comes into a first zone, it's the most easiest trades that you can ever take. Does it print opposing order flow levels? If it does, maybe the power to the opposing power is not that strong and you don't want to take that trade. All those questions of approach, we will discuss it in a few seconds. And the reaction is when price is hitting on the zone and it's reacting to our first, we want to see that it's reacting the way we expect. If it's hitting on a demand zone, if price is just starting to show it's reacting upward, and if it does, we want to see new order flow zones that being printed before, or maybe we can see some fake out patterns that we can rely on. We want to see the Wyckoff loading pattern that can give us a very big hint that the big guys are interested in switching positions. So that's about the reaction. So when we assess the upcoming trade, we look at the region, we look at the approach, we look at the reaction. Okay, so now let's start giving grades to whatever we see, and here's the cheat sheet. Okay, so at the region, we will give grades to the way that price is going away from the decision point. Okay, so when it's obvious and price never came back quickly, it's pretty much self-explanatory and strong. Okay, we can have a high probability that there are buying orders waiting here to be filled when price will come back here. With that impulse, there's so many buyers that and so many buyers that are involved in that reaction, that in here for sure we have more buying that waiting for us to take. Okay, so when price is coming back to that price, we want to buy it, right? But then if we have this decision point here, and then price is going back and taking that decision point, it's not really it's not really strong. But then again, because that movement had created some significance by breaking the opposing order flow zones like this supply, then we can assume that it still has some power in it. So maybe we would want to trade this with a confirmation of lower time frame with lower time frame confirmation patterns, or we want to give to trade it with less money that invested on this. It has less significance of success. And then we have something that is really weak. Price is moving every time it makes some kind of significance. It come back and consume the level, and it consume again. So the whole area here is actually being a compression area. And you know, and you all know what happened in a compression. There's no resistance here. There's no demand in here because it's all being consumed. Okay, so when we see that, we don't want to trade it because we know it's all being consumed. We see the compression. We see it went out. It started out as compression, and so they already took whatever was here. They loaded their power to go up. It did make some results, but to go there and to make that accomplishment, they already used what was loaded in here. So we are not going to be the suckers that's going to try to buy at an area that we know for sure that has no orders in it. All right, so we have the strong, the medium, and the weak situation that will give us for the same outcome, for the same outcome, will give us different grades for how to decide if we want to take that buy, yes or no. Pretty much the same for the sell, okay? Another thing on the origin is the effort versus the results. We were talking about this. We have this demand level, and when a demand was happening, it didn't break any support. Okay, so we see that these demands will not work in this situation. We also see that price is pretty much reacting and obeying the supply. And so if price will come back to this demand, we still don't want to take it because demand in this situation never broke supply. So obviously supply is stronger. We don't want to be the ones that going to buy weak demand, okay? Even if that is fresh. And when price was coming here, this was fresh, but it was fresh because it was fresh, but was quickly broken and never been obeyed as a demand because it came from obeyed supply, because it's in a context of strong selling. Okay, so that's a weak situation. But then we have the strong I'm sorry for that for this one. It should be strong. The word weak shouldn't be here. The strong thing is that we have a demand creating. We have the result of breaking supply. Then price is going down, taking that these remaining orders, but then breaking again the supply that was formed in here. So when price will come back to this demand has significance in it, because it belongs to the context that keep breaking supplies. It also belongs to the context of creating demands, higher demands all the time, printing demands on the way up. Okay, lower demand and higher demand, and keep creating achievements as results. Okay, so we'll give it a strong grade. Another thing that we really have to watch for is if the decision point was tested. Okay, we have this decision point to go up, but price never came to test it. Many times we have a situation where price is having a decision point like here, going down and then quickly being tested and continue. Okay, this is a situation similar to compression. Price is still going the way that we think we're going, but we cannot assume that there are sales orders in this, because these spikes were taking this. And here we have another decision point for price to go lower with very cool results, very good achievement from that origin, but price was quickly taking testing the decision point, and so we cannot assume that this level has any orders left. So this whole area, we call it a compressed area, which has no sales orders to hide, and we will not want to sell it. We'll give it a weak class. Same thing here. We have this decision here, and price coming back and spike, and you must consider there's no real difference between the body of the candle and the spike, because every single everything that is plotted on the canvas is a trade that happened in the market. So it doesn't mean, time is just a random thing. This trade could happen 1 hour later or 1 hour earlier. We don't know that. It doesn't matter the time. It doesn't matter the amount of trades that were happening here. The fact is that there was a trade in here, and that trade for sure broke this one. Okay, so we don't mind if it's a wick, if it's a shadow, or if it's the body of the candle. It doesn't really matter. So don't give less thought to the shadow, to the spikes. Okay, so we have a decision point for price to come, and then it's being spiked down, it's being pinched, pierced, whatever you want to call it. There are no orders in it. This is why we give it a weak significance. We don't want to buy in here. Maybe we would want to buy in here, because this one was never tested. Okay, but not here. When price is being going away from the origin, we will consider the very beginning of the reversal, the lowest extreme of the reversal, whether it's for short or for long. This example is for a long. The very extreme will always be the strongest, because the smart players of the market and the ones that do have the ability to manipulate price in the market, they would want the best price possible. And the best price possible is always around the extremes. Nobody really cares to buy here as a strategic way. It's only going to be tactic. And if it's tactics, it's going to be for a short while, and you cannot really trust mid-range levels. This is why you cannot trust mid-range levels. But the extremes, the origin of the turning point of price, would always be the real target for the smart and for the smart buyers in the market. So just remember that this is the logic of anyone that has the ability to push price to where they really want it. And this is one thing that you really have to understand about the big players of the market, that they do have the ability, and they are professionals, and they know that this is the price that they want. So this, when price will come to here, to the extreme, it will have much more significance than this level or this mid level or this mid level. Again, sometimes when price is starting its way up, these players cannot push price much lower than the second step or the third step. So the first few steps after the turning point, the extreme turning point, if these levels were printed after the turning point, these will still have some reaction. We give them a medium significance because we cannot know for sure that the motivation of the big players, we don't know if this will satisfy them or if they would want to push price lower before they buy it. But so this is why we'll give it a medium. And when you trade these mid levels at the beginning of the turning point, you have to be very careful. Maybe cut the money that you put on that trade before you maybe you can scale up when you have a better confirmation that price is really reacting the way that you want to this level. But don't put your full money on this. You can put more weight on the extremes than on the mid levels, and on mid range and upper, you just give it a very weak significance, and you would trade it only if it's really obvious, and only if you have confirmation, and only if you just put careless money on it. Okay? The approach. The next thing, price is really coming into the level that we want to buy, and we have to look at how price did come to that level before we want to trade it. So we have few situations on that. First, the most basic thing about supply and demand and order flow is that if price is coming and it's coming to untested level, then we can take it, and that would be the safest way to trade. But then if it was already being tested, our assumption is that we don't know what is the order flow balance in this zone anymore, and we consider it as consumed. So at the second level, we really don't give it a high quality. We will give it a medium, and we will try to look for better hints to trade the second test. Maybe if it come after this level was resulting by breaking another level, and if price was turning back to the second retest, not from significant supply, all sort of things that will put some logic in why you should grade this, consider taking this level once again at the second retest. Okay, maybe if price was not reacted to a supply, to a first supply, and then coming back in compression, then maybe we'd want to. So we need to have more things to it in order to take the second trade. This is why we give it a medium significance. But after the second touch, we really don't want to take it. For us, it's really being consumed. It's been shown a few times that it's being consumed. We'll give it a very weak grade, and this level, from the way that we can analyze, is very fragile and tend to be broken. So we would not want to take it after the second test at all. Okay. Another thing on the approach is if price is coming on a compression. If price coming, if a supply being compressed into a fresh demand zone, then we'll give it a strong grade. And if price is not coming, it's coming very in very high momentum, and it has no more clues. And of course, we have to understand this tip, what it is reacting from. Usually, if it's reacting to a fresh supply and it's coming like this level will not hold at all, even if it's the first touch. Okay. What I'm saying about this, it's not 100% true, because many times when price is has this great impulse into a level, sometimes it can be a hint for that level to work, because if you think of the smart players of the market, if they would want to buy it and there are no really sellers in here, patient was gone in the market, so they just dropped they are trying to bring price down there, and there's no real resistance in here. Nobody is really selling. Nobody is really giving a resistance until we get to that level. So we have this hollow place, and price will just drop here, react, and then respond. So sometimes it means really the opposite, but because we're just introducing ourselves to this concept, do not consider this as because you don't really understand what's going on behind the scene here, consider this as something that will give you a weak classification for this zone. Okay. Another thing to consider, it's pretty much the same situation like the last slide, but I want to explain some more. We can have another explanation to what we're seeing. First, if we see that the opposing order flow balance is being consumed in this situation, we're going toward demand and we're thinking of buying, and we see that the sell orders being consumed all the time, then we'll have a very strong probability for that trade to success, at least up to here, right? But if we see that price is coming down to our level and it's building up, printing supply that are not being tested, and another supply that is not being tested, not being consumed, we can picture in our mind that we have a lot of packets of supply resistance in the way that will not let this trade to work. Okay, we have this resistance and this resistance and this resistance. Even though we're going to maybe have some reaction here, the resistance that our trade needs to make in order to break all these is so huge, we don't really want to take that trade. Okay, so we don't want to buy here. We see supply being printed, not being tested over and over, and we have these so many barriers of possible resistance. When we're going to buy, all these were going to be reaction in our trade. If it will ever success, it will be just tedious work for price to do it. Okay, so we don't want to buy this just because we see resistance being printed. Okay. The very key thing to anything about order flow, supply and demand, is understanding where is price coming from. Is it coming from a reaction to an opposing fresh supplier demand, or if it's not? If it does, it means that this was the target of price. It was loading here a lot of orders in order to come and break the opposing demand in here. So if we see price coming from a fresh high time frame supply approaching to demand, then we don't really know. We can assume that there are high sellers motivation in here. Although we don't know how much power of buyers we have here, we do, however, know that there are a great seller's motivation in the market at the moment. So in that case, we would not want to buy this level, not until we get some confirmation that this level is going to react. Okay, so we'll give it a week a grade before we enter. But then again, if price was not hitting a high time frame supply. It didn't reach there. We assume that price should go there at one time, and if it came first to our demand, then that would be the greatest thing for our trade, because we want to buy here and we want to exit our trade here. And since this is fresh zone that never been tested before, that would be great target for a buy trade that start from fresh supply, for fresh demand, and ends at fresh supply. But that's only if price was not a reaction to significant fresh high time frame supply. All right. Another thing on the approach is if we see that the level that we want to buy is starting to affect before price is reaching our price, and for this you really have to equip yourself with a lot of patience, because sometimes you have that level and price start reacting before, and you think to yourself, maybe I analyzed this line in a wrong way, maybe it should have been higher, and then you buy here. Stay honest to yourself and to the level that you analyze, and stick to your trade plan, because sometimes price will start getting resistance before the level comes in. Also, you can explain stretch lines all the way to these to the impulse to the origin, and see why price is starting to bounce before it goes down. But if price is slowing down before it's hitting your price level, then it's a good sign that these levels show accumulation of more buyers. More buyers are entering the market, and in a way they are slowing down the selling movement of price. Okay, and that's a good sign. But if price is coming very fast into our level, we'll give it a week significance. We'll give it a week significance, but like I said before, at some cases, but you have to be more advanced if you just before you consider taking this as a trade, go and learn why and how to define the right circumstances for this. But when price is going very hard on this, it's a weak significance. You will have to ask yourself more questions about level printing in the way where price is coming from, and more questions like this to give yourself a better assessment if you really want to buy it. But in broad, it's a weak situation for you, less probability. And now we move on to the last part, which is the confirmation, the price action confirmation that we're looking for after price was reacting to the level. We marked that level, we marked that decision point, and we see price reacting the way that we expected, but we do want to see to have more confirmation after price had hit that level. And with that, if we see that price is reacting in a way that it's printing more decision points in a very clear way, and we see it's building up and it's not really consuming the levels below, then we can assume that this zone is really collecting more buyers, and we can enter the market. But sometimes price is just reacting in a very immediate way that is not making any significance. It doesn't break any low time frame levels like it does here. Okay, it's breaking here low time frame supplies. So here it's not doing that, and even though we have this reaction, it's still not a confirmation. It will be a confirmation if we see a fake out and breaking this level. Then we'll start see this engulfing pattern that will maybe give us a hint. But once it's not happening, price is probably going to break this level and maybe go very, very deep into that zone if it's going to obey it. Maybe it's going to obey it from very deep inside. So we don't want to be in that trade unless we have a confirmation that shows printing demand inside a demand zone, or as a reaction to demand zone, or creating the fake out patterns that we're discussing at the starting of this session. Okay, another reaction which is really, really much aftermath is if we can recognize the Wyckoff loading and unloading, the Wyckoff unloading and loading patterns. And this we can see very much after it's already being happened. If you're a Wyckoff trader, you would, if you're a very skilled one, you probably will be able to trade from these areas. If you're less, you probably can enter only here. But if we came to the market and we see these patterns, we already understand that the big players were unloading their huge positions, and then they were starting loading their huge opposing position. And when we see this, we know where the market bias is. So understanding the Wyckoff unloading and loading pattern is very important to understand that you're in the right direction, but you can do it very much aftermath. Okay, and if we're supply demand order flow traders, and this line represents a possible demand, then we can maybe try to find our trade in here or in here, and get the very best price for that. So that is today's session, and I really hope you enjoyed the whole series. And if you're interested in learning more about order flow, about price action, about supply and demand, you can just click it on Google and you'll find a lot of things. Also, you can go for Forex Factory forums. There are few great threads about this. The best thread on Forex Factory that I can recommend, called Price is Everything, which is a combination of supply, demand, and advanced price action. This is actually my Bible for trading, and the essence of these I was teaching here on this series. There are more dedicated websites that teach the things that we were discussing in the series. If you weren't attending the past 3 sessions, I highly recommend that you go and watch it on our YouTube channel or in the recording area in investing.com. I just remind you that our fund is always looking to recruit great Forex traders. If you know anyone that you can refer to us, we very generously reward anyone that refer to us traders. So all the information about the referring program is on the website. And if you are a trader and you want to try out with us, we welcome you to see our plans and the way that our workflow goes and the potential that we provide to good traders. The basic thing is that if you have a trading system that will give you 1 to 1.5 risk ratio, then your place is with us. You can really grow your trading career with us in much more accelerated way than you would do with an individual retail account. So I highly recommend that you go and check on us on our website. If you know good traders, please refer them to us, and we rewards in cash anyone that help us meet great traders. And thank you so much that you were attending. The session are recorded and going to last forever in the internet, I hope. And if you have questions, feel free to write to us or to contact us on our Skype channel. And we're there to communicate with anyone that love trading and want to learn. We're there for you. So thank you so much, and have a great evening.